Hi everyone, welcome to another Port Jackson Securities webinar. Today we are joined by ETF expert John Caulfield from VanEck. Thank you so much for joining me today, John.
Thanks for having me.
So today, John will be giving us a presentation to introduce ETFs and VanEck, and then we will finish off with a Q&A. So feel free to submit any questions whilst John is presenting. John, would you like to start us off then?
Yep, perfect. Well, look, thanks again for giving us the opportunity to have a chat this morning and talk all things ETFs. We'll be sort of running through, I think, sort of, from the basics, a few slides on, what are ETFs, and then, progressing into what are probably some of the more sophisticated, more recent developments in the ETF industry, and then, touching on a couple of funds to sort of illustrate that. So hopefully in terms of, the level at which this presentation evolves, all of you will learn something, but please feel free to send through questions. Very happy to do sort of Q&A on anything, once the presentation's wrapped up. And as you can see on the page in front of you, get in touch with us on the socials, Twitter, Facebook, LinkedIn, send through any questions. We have a lot of great content on our website in terms of educational information on sort of ETFs and obviously our product suite as well. So very happy to sort of hear from you and to help any questions that you may have. All right. A little bit about me. I manage some of the client relationships for VanEck, covering sort of New South Wales, Queensland, and New Zealand. That covers institutional as well as sort of broker and financial advisors. So it's the full sort of spectrum of intermediary clients that I deal with. And obviously the usual disclosures as far as everything I say here today is going to be general in nature. So please consult your advisor or your broker to see if these products or anything that's mentioned is actually suitable for you. And obviously there's PDSs and the like on the VanEck website if you did want to have a look at any of those in some more detail. So as I said, we're going to go through a few, I guess, basics in trying to understand how to make sense of what is an ever-growing lineup of ETFs. Traded on ASX, obviously sort of locally and internationally. The ETF industry has been growing exceptionally strongly over the last sort of 5, 10, 15 years, and plenty of products out there. And if you don't know sort of how to assess them, how to get to a sort of short list, it can be quite overwhelming. And obviously understanding the products appropriately will make sure that at the end of the day you're getting the desired investment outcomes that you hoped for when you went into one of these products in the first place. So as I mentioned, these days you can go into sort of any broad market, any specific country, sectors. You can invest based on factors. We've got a lot of bond ETFs out there as well, and a few thematics, obviously sustainable, ESG, clean energy, video gaming, all sorts of ways to slice and dice the market are available now. So like I said, how do you do some research and essentially filter what is potentially a very large and confusing universe? So we've got a few steps here to help you. Look, all of these funds trade on ASX. I think that's obviously an important thing to sort of clarify up front. Exchange traded funds kind of says it all. So ASX is a very good resource in terms of doing a little bit of further reading. They have a monthly report that comes out that covers, as you can see, all ETPs, so exchange traded products. So what that covers is both active and passive ETFs, also a couple of the LICs and that sort of thing. So anything that trades on exchange will be covered by this report, but they do then have a lot of detail in terms of fees and size and trading volume and how long it's been around. And so that is a pretty good ultimate resource to cover the entire market. And then obviously each ETF issuer has some pretty good information on their own websites. And you can see a screenshot on the right hand side there of our web page and how we sort of break down our funds. So VanEck Australia, we currently have 30 ASX listed ETFs, and you can see there most asset classes covered, Aussie, international, some sectors, some sustainable ESG. I mentioned a few of the thematics. And then on the right-hand side, we've got 5 fixed income ETFs as well. So 3 of those are passive and 2 are actually active ETFs. So, you know, in terms of active versus passive and market cap versus smart beta and that sort of thing, we'll delve into the sort of details and how to differentiate in a second. But I think it's fair to say, you know, VanEck covers most of those bases as well. You know, what we try and do is do a sort of best in breed approach. You know, look at the asset class we're trying to provide investors access to, and then deciding what the best way to go about that is. Is it passive? Does that mean traditional index sort of market cap? Or do you do something a little bit different at the index methodology screening level to get you a better exposure to that particular country or factor or whatever it may be? So for those of you who don't know much about VanEck, I might just sort of use this slide to cover off who we are, where we've come from. And I mean, the second point of this you know, checklist is to basically assess the fund manager, which is what we are. So VanEck is US headquartered. We've been around since 1955. So have been managing money globally for a very, very long time. Obviously, that was pre the ETF industry. So VanEck started life as a traditional active mutual fund manager and does still offer a couple of those strategies offshore, both in the US and in Europe. But we are best known now globally, and obviously particularly in Australia, for our ETF products. So the first ETF, firm-wise, started trading in New York in 2006. We've now built that out in the US to probably 60, 70 ETFs trading across various exchanges there. We have a European business as well with a lot of UCITS products, and set up the Aussie business around 10 years ago. As I mentioned earlier, we now have 30 exchange traded funds listed on ASX. So we've been going at sort of 3 or 4 funds per year as far as new listings go. So, you know, we don't just proliferate a lot of product. I think we're quite well considered in what we try and put out. So like I say, we've got this unique position where there's quite an active heritage in terms of the business. So we like to think about things in a slightly different way to just your traditional broad market cap passive index approach. And there's been a bit of an evolution as well in sort of indexing, index methodologies, and the sophistication that a lot of the global index providers actually bring to the table now, where, you know, some of these techniques, whether it's focusing on a single factor or doing something, like I say, you know, beyond market cap at the index level, traditionally those techniques were either purely in the active realm or available only to sophisticated institutions. And I think what the ETF industry has brought to the broader market is access. So, like I say, a couple of the examples that we'll talk through later illustrate that. But, you know, we're certainly bringing, I guess, you know, traditional finance 101, but with a bit of a twist and wrapped up in a very sort of, you know, accessible wrapper as far as the ETF itself. So again, I mean, just, you know, looking at our website, you can kind of get a flavor for, I guess, the supporting research that we put out behind a lot of our products. You know, a lot of it is, you know, new to the market in terms of the Australian context, at least. So, you know, education is a massive part of our remit. Getting out there, letting sort of, you know, advisors and end clients understand, you know, differences in methodology, difference in risk return characteristics that you may get. You can look at ASX and there are 5, 6, 7 different Aussie equity ETFs. They will all do something different. And the importance in your selection process is understanding, you know, how they're going to behave in various market cycles, and all that comes down to is understanding that sort of methodology in the first place. I mean, another important point at the bottom there, you know, what is the manager's track record as far as opening and closing funds go? You know, the Aussie market is not as developed as the US. So I think, look, it's fair to say overseas, there are a lot more funds that do close. You know, here we have had, not VanEck, but in the market in general, a few products from other providers have been closed over recent years. I mean, look, I think, you know, it's a sign of an evolving market for sure, but it's obviously not pleasant for any clients that are, you know, in a fund that the provider decides to close. You're therefore forced to sort of find another place for your money. So I think one way to alleviate that concern, you know, is think long and hard before you actually bring a product to market. And as I alluded to earlier, that's something that I think VanEck are very good at. It's something we're very proud of. You know, we don't just bring all sorts to market and hope, you know, something sticks. You know, we make sure, you know, all products can stand on their own 2 feet. The investment rationale is a long-term one, and it's sort of grounded in, you know, academic theory or research. You know, so that obviously increases the chances of these sort of products having good longevity. So the key to differentiating and understanding an ETF, as you can see there, you know, is to take that step, you know, deeper and look at the index methodology. So, you know, at the highest level, an ETF is a passive product. As I mentioned earlier, there are now active ETFs, but they are labeled appropriately. So unless you see the word active ETF in there, you know, the fund is going to be tracking some sort of an index. Now, again, when people talk passive or people talk index, they don't necessarily have to be ASX 200, S&P 500 type funds. You know, those indices have been around for a very long time. They were developed more as a sort of barometer or benchmark of, you know, what is the market doing today? And generally that number was published in a newspaper or some other sort of media outlet, like I say, as a very sort of broad sort of headline level for investors to understand, you know, what's happened on a day by day or month by month basis. They weren't necessarily designed to be, you know, investment products or underlie investment funds. So, you know, looking at the index methodology, you know, what are you trying to achieve? Are you just trying to buy the whole market and do it cheaply? Then obviously a market cap benchmark does make sense. But again, understanding exactly how that selection process, you know, is carried out is important. But if you're going beyond market cap, does the concept, you know, stand up to scrutiny as far as external research goes? Obviously, you know, there's a lot of independent academic research that's been carried out globally over the last sort of 50, 60, 70, 80 years. You know, that's the sort of thing that you want to be basing your investment rationale on, not just the latest fad or the latest sort of sector that somebody says is, you know, going to be the thing to be in for the next year or two or whatever it may be. You know, there's obviously pitfalls for trying to be, you know, a little bit too narrow or too cute as far as, you know, the investment universe goes. You know, being diversified, making sure asset allocation is appropriate, all of those sort of basics, you know, do still apply when investing in ETFs. And then the last point there, I mean, is the index methodology easy to understand? I mean, could you stand in front of somebody else and explain to them, you know, this is how the fund is selecting its holdings, this is why we're doing that? Again, whether it's concentration risk you're trying to alleviate, whether it's a specific country or a specific sector or a factor that you are trying to target, you know, is it a black box in terms of the methodology, or is it something that's quite transparent, intuitive, and makes sense as far as that screening process goes? So, like I say, even if these methodologies are a little bit more complex in some regards than market cap, they still need to be easy enough to understand to make sure that you know what you're getting at the end of the day in terms of your investment outcomes. And I mean, track record is obviously one way to assess these things. You know, there's always the caveat, don't rely on past performance, but, you know, it's all the performance we have in some regards. But, you know, there are various ways to cut it as well. And I mean, this chart just illustrates that, you know, at the top there, if you're looking back the best part of 10 years, you know, you've got the orange line as the worst performer and the gray line as the best. But if you look at the last couple of years, same performance underlying, but only from August 2020, you know, you can see very different outcomes as well. So it's important to look at the longest track record you can. Obviously understand, you know, what the different economic environments were over that time, and how did the index strategy or the ETF strategy react to what was going on within the broader economic context. And then also, you know, funds list on a certain date, but they may be tracking indices that have been calculating in a live environment, you know, for a number of years prior to that. But then there's also index history, which is basically just sort of a back-tested theoretical element as well. So I think it's important to understand if there are those three separate components, you know, what is the live fund track record? What is, I guess, the live index track record, because that's obviously a good indicator of how the fund would have gone. And then there's the sort of, you know, back calculation, which again, you know, a lot of what I was saying earlier, very sort of niche approaches, you know, could just be the result of some data mining, and, you know, you tweak the numbers hard enough, you can make anything sort of jump out if you really wanted to. So, you know, just make sure the provider that you are assessing or the fund that you're assessing is pretty clear on, you know, that distinction, and try and obviously get as much, you know, live reality as you can in terms of your analysis. And then costs, I mean, look, obviously costs are very important, and I mean, have been a good tailwind for the ETF industry in general. So historically, you know, managed funds or broad sort of portfolios, you know, have been the realm of active managers. They generally will charge a fee, and they're trying to outperform a benchmark. I think in recent years, the scrutiny on that sort of value for money piece has certainly grown, you know, since the GFC, even through COVID. You know, am I paying too much for the performance that I'm getting net of fees at the end of the day? And obviously, management costs are important. They are probably the bulk of your total fees, but they certainly aren't the total cost of ownership. So I think, you know, whilst a headline MER number, you know, is important, you've also got to assess things, and this is obviously relevant to the exchange traded world, the buy-sell spread. So, you know, if there are two funds that you're assessing and one's 5 basis points cheaper, but you're going to pay 20 basis points more on exchange in terms of spread, it's actually cost you more to buy that, you know, potentially less liquid fund. So again, there are a few layers to assessing fees. You know, brokerage is obviously something outside of the realm of, you know, VanEck or any investment manager. But again, that's an important consideration in terms of that total cost of ownership piece. You know, that does come into this. So like I say, make sure all the components are pretty clear, and you're happy that, you know, the fee you're paying should deliver you, like I say, net of fee outcomes that sort of justify whatever level you land at. There's obviously risks, as with any investment. You know, these are all detailed pretty explicitly in our PDSs and every other provider's PDSs for that matter. So, you know, jump on our website there if you did want to have a read through. But, you know, obviously, you know, there's specific sector risks where you've got international equity ETFs. You do have, you know, different markets. Obviously, foreign exchange comes into that potentially if the fund is unhedged. Within fixed income, you then start looking at things like credit risk, you know, and then there's, you know, hedged ETFs, which should take currency risk out of it as well. So, you know, just understanding again what your underlying portfolio will be made up of. Is it equities? Is it bonds? Where are those traded? You know, what additional risks do I need to be aware of? Again, just, you know, in discussions with any advisor or broker, all of these things do need to be looked at to make sure everyone's comfortable with where they end up. A few other things to talk about as well. Tracking error is something in sort of index world you may hear a little bit. It's basically our investment objective, VanEck as the investment manager, to track a particular index as closely as possible. So that literally is the investment objective in the PDS. So what you want to see from any manager is, tracking that index as closely as possible. Obviously, fees are not reflected in an index, so we can only track an index as close as we can, notwithstanding the fees that come out of the fund. So if you look at a 12-month performance of the NAV versus the index, the only difference you should actually see is that MER that we spoke about earlier. If that sort of divergence is any larger, it would be worth looking into that a bit more, and maybe the manager isn't doing as good a job as you would hope as far as tracking that particular index. There are also some tax advantages as well, and again, without sort of getting too complex and going down too many rabbit holes, if you just sort of compare listed, i.e. exchange traded fund versus unlisted traditional managed fund, there are some differences as far as capital gains tax goes. So if you think in unlisted world, you want to redeem some money, you send off your form to the manager, you say, I'm pulling out X number of dollars. What they then need to do is go and sell down the portfolio to generate the cash to pay you back. Selling down that portfolio may generate a CGT event. So there are then some gains, some realized gains that are sitting in the fund. So you as a withdrawer of your money, take your cash, off you go, and those gains are left essentially in the fund. And so existing investors, or sort of those investors that are left behind, essentially wear that liability. And that can be, quite a large event come 30 June. If a lot of people have pulled money out of an unlisted fund and you're the one left in there to wear all of those sort of, realized gains, it can, I think, distort the experience of the investors. Whereas with an ETF, you as an investor are buying and selling units on an exchange, potentially buying and selling off each other, potentially buying and selling off the market makers. You're not actually buying or selling directly with VanEck as the manager. So we deal with the market makers, and then the market makers put the units on exchange, and those are then bought and sold in that sort of marketplace. So the only time there's a sort of tax event in an ETF is where the market maker comes to us and says, okay, well, we need to redeem some units. We will sell down and basically cancel the units, but then we stream any capital gains that may have been generated back to the market maker. So the end client is actually removed from that process to some degree. So it's quite a unique setup in terms of how ETFs operate, where there are some tax advantages in terms of capital gains being between ourselves as the manager and the market maker rather than the end client. But also just generally the active passive nature of ETFs. Passive tends to be a lot lower turnover than active. So we're generally buying and selling less within the fund anyway. So we're generating less CGT within the fund, and it's a bit more kind of buy and hold, longer term holdings. So you just generally don't have as much CGT and turnover going on in passive funds anyway. But like I said, I hope that's clear at a highish level. Don't want to go down too many rabbit holes there, but so there are some advantages to be aware of. So just a quick summary. I'm not going to sort of run through all of these point by point. It just covers off what we've sort of touched on. But it's worth doing some reasonably detailed research, I would say. Once you've created your shortlist, once you've decided what asset class, country, whatever it is you are looking for, and you've got a couple of providers in front of you, understand the index, understand the manager's track record, all the fees, all the risks, and ultimately decide if that's going to give you the exposure or the outcome that you are hoping for. So to take a little dive deeper, we will now look at a few sort of index methodologies and the like. and understand exactly what it is that drives, the ETFs. So, like I said, the top 4 there, we've sort of been through. What are we trying to achieve? Is there some academic research supporting it? Is it easy to understand? And has it performed as expected? So, different indices, again, we've sort of mentioned a few, will give you different outcomes. Market cap is just, look, buy everything, apply the largest weight to the largest company. In the Aussie context, that would be a BHP, and then the rest get apportioned, determined by how large a company they are. So that's great in terms of getting a broad outcome, but particularly in the Aussie market, there's a lot of concentration risk, both at a single stock level and at a sector level as well. So how do you alleviate something like that? One way to do it would be to take an equally weighted approach. So to say, look, we're going to pick X number of companies and we're going to assign each of those an equivalent weight. So immediately you're getting a sort of much more diversified basket of stocks. Factor indices as well, something that's becoming a lot more prevalent of late. We'll talk a little bit about quality as a factor. You will have no doubt heard of things like value investing, momentum, small cap, low vol, things like that. So it's basically saying, look, these risk premia exist out in the market, and we can try and harvest those essentially by investing in an ETF that screens companies for those particular characteristics. So you're investing in a subset of the entire market to try and hone in on some particular characteristics. And then capped weightings, again, where particular sectors might be quite concentrated. So Aussie REITs is another good example. It may be, all you need to do is cap an individual holding. We have an A-REITs product that, Dexus, Goodman, Center, cannot be more than 8% of the index. So instead of, half of the index being made up by 2 or 3 stocks, you're basically saying if nothing can be more than 8%, immediately you're getting better diversification. So it can be something reasonably simple like that. Again, that sort of flows into, the developments that I spoke about earlier as far as indexing goes and smart beta in general. So, we would basically say anything that's not market cap weighted would broadly be in that smart beta bucket. So you are taking an index methodology that's different to broad market cap. So you're still passive, you're just not, like I say, giving the largest company or the largest bond the largest weighting in the index. And a lot of this has been driven by people being, more and more underwhelmed by, what active managers have been delivering on a net of fee basis. So S&P actually put out a really interesting report. It's called the SPIVA scorecard. Again, I think through ASX you can get a hold of that, or definitely through S&P. And it just looks at various time frames and says, how many of these active managers have actually beaten the index over 1 year, 3 years, 5 years, and 10 years. And I mean, the numbers are pretty stark for the active management industry. And again, that's not to say that there aren't some great active managers out there and you aren't going to get, some years that they do really exceptionally well. I think from an investor's perspective, the difficulty comes in picking that manager ahead of time. And then what you can see here, the persistence of the outperformance. If they do happen to do better than benchmark for a year or 2 or 3, the chances are that they won't be outperforming over 5 years or 10 years. So, there's 2 elements to it. Initially, it is very difficult to beat the index after fees. But secondly, the longer the time period, again, those that were doing relatively well compared to the index tend to sort of drop off as well. So the persistence of outperformance really does drop off over the longer term. So, using sort of broad index or smart beta is certainly disrupting the traditional way of investing or allocating capital, and I think it's making sure that any active manager who are trying to beat a benchmark and say they can are being held to account, which is great. And like I say, there are some really good ones out there, and they'll continue to benefit from what is, I guess, a rationalizing of the industry. So smart beta essentially sits right in the middle of traditional passive, and again, we're talking market cap with that black circle there, and traditional active. So it's using some of the techniques that active managers have been using for decades in terms of how they screen stocks or how they assess relative value, and it's wrapping it up in an index-based product. So all the rules are, decided ahead of time. They're transparent. It's all quite methodical as far as the reviews and the rebalancing and what comes in and when it goes out and that sort of thing. So there's no discretion at the point of the index manager. We're going to sort of track the index, but as I said earlier, we put a lot of thought into defining that index before we actually launch the product. So you're getting quite sophisticated methodologies, but you're getting it wrapped in a relatively cheap, easy to trade, transparent wrapper, which is the ETF wrapper. So, again, all holdings are published on our website every day, which again, with active management, you just do not get that look through. So a lot of people like the transparency of ETFs as well as the lower fees. A great quote here, Eric Balchunas, he's quite well known in sort of ETF world, US based, obviously, he works for Bloomberg. So smart beta is essentially that blending, like I say, of a systematized approach, but Peter Lynch is pretty famous for being sort of a stock picker that relied on pretty easy intuition, if you like, in terms of assessing whether a stock was appealing or not. He walks into a shop, or his wife says this is a great product, and bases a lot of his analysis on that sort of approach. So smart beta gives you something like, say, the blending of that sophistication with some fundamental sort of stock research. And it's certainly the fastest growing category as well in terms of the ETF industry, both globally and in Australia. And you can kind of see that here. And, the first non-market cap way of approaching things would probably be to say, look, let's pick the highest yielding. We want to focus on yield, whether that's for income or franking or whatever it may be. That in itself is a screening process that we would say fits into smart beta. But again, that's evolved now, obviously through sort of capped weightings, equal weighting, quality, ESG, China A shares. We have a product which does some, quite quantitative screening of the stocks to make sure that you're buying, the most fundamentally sound companies that are available. And then, applying similar sort of quant screens to a couple of sectors as well, like healthcare. So you don't just need to buy, the whole sector or the whole index, to get that sort of thematic. And it's certainly becoming a lot more mainstream as well. We run a survey every year where we speak to advisors and brokers and just sort of go, well, look, how many of you are using it? How many are happy? Why are you using it? And do you think you're going to do more in coming years? And like I say, it's certainly becoming pretty broadly adopted. If you're not using it, you're certainly considering it. And most are considering smart beta as a replacement for active as well. So it's, again, probably a bit of, a fee-driven approach, but again, just being quite happy with the level of sophistication that some of these strategies can bring to the table. So say 99% are happy. We haven't found the 1% person yet, but it'd be good to have a chat to see why. And look, 3/4 think that they will become more prevalent in portfolios as we go forward, and obviously half will increase their allocation over the next 12 months as well. So again, pretty promising signs there for taking the sort of smart beta approach. So we now come to our first of two examples. So this is our largest fund. So you can see there in the blue, the ASX ticker is QUAL, QUAL. It's our VanEck MSCI International Quality ETF. So it covers developed markets, excluding Australia. And again, I mean, what ETFs, provided when they first sort of came to market a decade ago was, instant access to offshore markets. Obviously, a lot of people are very familiar with the ASX and individual companies that trade on ASX and are happy to sort of do the research and make investments on that rationale, but you've got this massive universe offshore. Aussie makes up about 2% of the global listed addressable universe. So, there are a lot of opportunities out there, but these are companies that we're not necessarily familiar with and we don't have access to the research on. So, buying an ETF is a great way to get instant diversification to these offshore markets, but also it's a way to sort of do it in a selective way. So obviously a couple of big brands everybody is aware of, but like I say, if you want to be a bit more selective than just buying the broad index, something like quality, is quite a consistent, persistent factor. And again, it's very well established in sort of academia. And although Ben Graham was obviously a well-known value investor, if you look at his 7 fundamental measures that he assessed companies on, 3 of those are actually quality metrics. Strong financial condition, i.e., strong balance sheets, low leverage, is obviously a good place to be as far as companies go. You want companies that are actually earning money, and that earnings, profile is quite stable and ideally improving over time. Earnings growth is obviously indicative of underlying health. So, like I said, a few of these sort of metrics and fundamental measures that a lot of people assess companies on feed into this quality approach. So how does quality behave in certain markets? And again, it's important that you sort of do break down historical performance in terms of what was going on in the greater sort of economy at the time to understand going forward, what to expect. I mean, these things are never going to outperform, all the time, but you need to understand what the relative performance, is being driven by. So, if we just start in the middle there on the GFC, quality being the dark blue line, there has been a market drawdown within the GFC. We all know that, but, if the market's down, you want to be down less. And that's what quality did in that particular environment. So if you go back to the .com bubble, we saw similar behavior as well. And then all the way on the left, some tech booms. The dark blue line is above the benchmark. So it's not only to say, we hope to, draw down less when markets draw down, but we also can participate and potentially outperform in up markets as well. And you can see that post GFC performance there is pretty stark outperformance for quality. So again, knowing what sort of environments quality behaves in helps understand what to expect. And you'll see the 2000s sort of credit boom in the middle there is the only sort of time you can see that dark blue line underneath. And that's when we had high growth, high inflation, quality was up, but everything else was just up more. So when we do see that sort of environment again, you would expect quality to potentially lag the broader benchmark. It's still up, it's just not up as much, sort of the junk rallies more, if you like. But in every other market, quality can be pretty consistent, which is why we really like it as a core allocation in portfolios. So you get the benefits of the drawdown, but you can also participate when things are going reasonably well. So a few sort of metrics there on the right-hand side. You can see this fund of ours has been trading since October 2014. So the ticker I mentioned, QUAL. This is an unhedged fund. We do have the same strategy, the same underlying stocks available in a hedged ETF, and the ticker there is QHAL. You can see at the bottom there, we run sort of 2.7 billion in this particular strategy. We've got around 400 million in the hedged version as well. So between them, have been very popular. You would have seen on that initial slide, won quite a few awards from various research houses and the like as well. So, Qual's been a really good fund for us. On the left there, just a summary of those sort of metrics in terms of how the index provider at least does that screening. You're looking for stocks that have high return on equity. You've got to have a positive ROE, but higher the better. Stable year-on-year earnings growth, low leverage, and that's where you sort of filter for your highest quality 300 companies out of that sort of 1600 stock broad universe. So like I say, it's passive, it's transparent, It gives you access to all the sort of household names, but it is quite selective. You're not just sort of buying everything that's available there. You want certain characteristics, in terms of those underlying holdings. And the longer term performance, you can see, has been pretty good. So like I said, the fund we've been running since the back end of 2014. The index has been around a little bit longer, and then we've got sort of index history back to 1994. So through a number of cycles, get a good idea as to how quality goes relative to benchmark. You can see there, this is the fund after fees against the broad index. So obviously the 6 months, call it year to date, we've actually seen value as a factor come back quite strongly. So, there's been a little bit of a rotation going on. So quality is sort of under over the shorter period, but over 3, 5, 7 and longer, pretty solid per annum numbers versus the index as well. So again, just sort of assessing over the longest time period possible. And then if we jump to the Aussie equity example, so again, you'll see these sort of methodologies are very different. So VanEck as a manager certainly doesn't apply the same methodology to global equities as we do to Aussie. Everything is assessed on a case-by-case basis. So Aussie equities, as I mentioned earlier, concentration risk is the biggest problem that we have down here. So a lot of clients assume that, I'm passive, I own 200 or 300 companies, therefore I'm diversified, therefore I'm low risk. And I think in our context, it's certainly not that simple. 45 cents on every dollar goes to the top 10 stocks. 11.5 cents of every dollar goes to BHP. So even though you own 200 or 300 companies, you really are not as diversified as you think. And the performance of your portfolio is beholden to, let's call it 10, 15 names. The other 185, 285, do not move the dial. So what can we do at an index level to alleviate some of those distortions? And we've gone down the equal weight route. So some of those percentages that I mentioned, obviously that top sort of 10 is the usual suspect list made up of a lot of banks, a couple of miners, telecoms, the usual names that, people probably own somewhere else anyway. They may have a couple of direct shares in a few of those names. And if you want to add an ETF, you don't want to be doubling up with what you've got already. So what we've done, as I mentioned, is take a sort of equal weight approach, but we haven't equally weighted the 200 or the 300. You can see down here the stock number, 90 at the moment. I'll go into a little bit of that detail as well. There's about 1.7 billion in this strategy, and that has been trading, so a little over sort of 8 years there as well. So quite a long track record. Whoops, where we gone? Sorry. This chart, I think, sums up quite nicely a lot of that concentration and distortion that I mentioned. So if you look at the left-hand side, the darker blue bars, those show, the individual stock weights within sort of on the x-axis, the top 15, 16 names. So you've obviously got a lot of weight on that left-hand side, and then, the dark blue really does tail off down to stock number 200 as well. So, everything about that portfolio says, concentration risk. So what we've done with our equal weight approach is, give 90 odd names an equal opportunity to contribute to the performance. And you can see that in the sort of lighter blue teal line. So, the same weight with stock number 1 as stock number 90 at rebalance. What that means is you underweight those top 15 relative to the benchmark. So we're not saying, adopt an X20 strategy. We're not saying don't own the banks. We're just saying don't own too much of them. And what you then get is obviously a slight bias towards some of the large and mid-cap names in that top 100, rather than just being focused at the mega cap end of things. So at a sector level, obviously the largest change you'll see there, sort of top right, is in the financials. So instead of having 30% in financials, if you did track the market cap benchmark, you're reducing that by around 10% by taking an equal weight approach. And obviously a lot of that's then sort of redistributed across other sectors as well. Same goes to the sort of market cap, cut, if you like. So the mega caps, as I said, is where you really sort of losing that focus and you overweight large and medium. And you can see there, we're actually underweight small caps because we don't sort of tend to hold much or anything in that 100 to 200 stock realm. So even though you have a size bias, which can be, attributable to smaller market cap, it's not small cap per se, because you do sort of stop around that sort of stock number 100 mark in terms of the methodology that we've gone with. So again, I mean, historically speaking, how has this performed relative to the index? And it has been, pretty good. You can see there the dark blue line, since 2002, which is the index history that we have, has been tracking pretty consistently above. And in terms of, ultimate dollars, you are in a better place if you had been in there since day one. But again, pretty consistent as well. I think we've got about 17 odd calendar years there, and obviously calendar years are, it's a reasonably blunt instrument to sort of assess things on, but again, pretty useful to just understanding the consistency of this approach. And I think it's 14 out of 17 odd years, equal weighting has done better than the broad market as well, which is, again, good to understand. So performance-wise, again, this is the fund after fees versus the index. And again, I mean, that 1 year number is really strong at this stage. So at the start of the year, look, BHP was doing very well. It then had this big sort of corporate restructure where, the secondary listing in the UK came over to Australia. That upped the weight even more in sort of the market cap benchmarks, and BHP was doing pretty well. So, market cap, the 200 was doing pretty well. A lot of that sort of reversed over the last couple of months. So that 1 year number in terms of our strategy is looking pretty strong. And again, since inception, we've typically seen between sort of 1% and 2% performance over that sort of longer term since we've been running the fund. So look, obviously everyone wants to outperform, but there's, two sides to the coin. There's the risk angle, which is just be a lot more diversified and have a kind of core where you aren't just relying on 10, 15 names. But then on the flip side of that, you're hopefully trying to do better than broad market cap as well. And that's really where I will wrap up. So look, I mean, have run through quite a spectrum there. Hopefully have given you some good insights wherever you are in terms of your sort of ETF journey or trying to understand the different approaches that are out there. But very happy to run through any questions now to cover off anything that I may have missed.
Thank you so much, John. I think that was a really good introduction for those that are beginners to ETFs, but also a really good snapshot of what VanEck does for those that are familiar with ETFs, but not VanEck specifically. So thank you so much for such a great presentation. We have got a few questions here, so I'll dive in. The first one is, what ETF strategies do VanEck believe are well positioned in the current environment?
Yeah, look, it's been an interesting year, as I'm sure everyone can attest to, and certainly the things that were working last year are not necessarily working at the moment, or certainly not working as well. I think one benefit VanEck Australia has, as I sort of alluded to earlier, we've got most asset classes covered and a range of different factors and that sort of thing as well. So we're not particularly dependent on whether it's growth or technology or whatever it may be. So, we've actually held up relatively well in terms of, our product suite. We're seeing some good inflows. Like I said, I mean, look, last year or the last couple of years, it's really been, the story of growth, assets, technology, that have driven markets higher, where we've seen a real kind of shift now where inflation has started to bite. We've seen rate hikes across the world, and those longer duration strategies, which technology is, where you're buying sort of earnings potentially 5, 10, 20 years out into the future on the sort of hope that these companies are going to get there, those companies have been, hammered and really sort of penalized. People have been flocking to the more traditional sort of value type names. And that's because those companies generally have, quite strong balance sheets, are better equipped for a rising rate environment, i.e. they are making money now and making sort of profits today. You're not sort of trying to buy profits in the future to, get you part of that growth. And, going back to something like quality, everyone likes the stability of companies that are, lowly leveraged and that sort of thing. There's also been, real assets, global resources, the commodity play to try and, hedge against inflation. So we've seen some good inflows into things like our global listed infrastructure. We've got a resources ETF which focuses on the Aussie market, which again, caps the BHPs and the Rios at a certain level, so you're getting better diversification. But then fixed income has been a real sort of pain point for a lot of advisors and clients this year, where my defensive bucket is showing up red numbers, and it's been the first time in a long time that clients have had to, I guess, understand that. And that again all comes down to having longer duration bonds in the portfolios, because if rates rise, if you've got long duration bonds, the capital value drops. So sticking to things that are lower duration, and by that I mean sort of floating rate notes. We've got two Aussie corporate bond strategies locally. FLOT is the ticker of our broad floating rate ETF, and then we've got sub-D, which is a tier 2 capital, so it's Aussie subordinated debt, but it's all sort of Aussie banks and insurers that issue this debt. It's all investment grade, so it's pretty high quality credit, and you need to be sort of clear that you're stepping out of the cash bucket into sort of credit. But yields on those two ETFs now are sort of 4s and 5s, because the curve is moving quite quickly and steepening and that sort of thing. So you can be reasonably defensively positioned in terms of, more rate rises coming, but still be getting, some pretty good income while you wait. And as those rate hikes go up, these floating rate notes adjust up with rates as well. So again, you can be quite nuanced, and I think, we've certainly seen, like I say, floating rates, shorter duration bonds be more popular, this year to date, but there's going to again become a point where some duration is going to start looking, cheap again, because it has been sort of all change.
Yeah, okay, thank you so much. I don't actually have any questions left because your presentation actually answered everything I was going to ask. So in that case, I won't take up much of your time, but if anyone does have any further questions, feel free to email me and I will pass them off to John. But thank you so much, John, for joining me today, and thank you so much for a great presentation. I hope this gave everyone some more insight into VanEck and ETFs. But yeah, any questions, feel free to email me and I will pass them on to John.
Thanks so much. Really appreciate your time this morning.
Thank you. Thank you. Have a good day, John.
Thanks, you too.
Bye.